Assalamu Alaikum everyone, welcome back to another video. So today's video we are looking at a growth companies. Okay, growth stocks are, according to Investopedia, a growth stock is any share in a company that is anticipated to grow at a rate significantly above the average growth for the market. So these are market beating stocks. It's fairly new. Okay, they are very new. They have a higher PE, for example, but such valuations could actually be cheap if the company continues to grow rapidly, which will drive the share price. And for this reason, a lot of us got into buying high valuations, the Zooms and so on, over the last 12-18 months, because you expected the company to grow at least 20, 30, 40% every single year. You're willing to pay extra, and that's a normal thing to do. Okay, and these companies are not well established. They don't pay dividends. They're not like a value stocks. They are growth companies. That's what they are. And one of the things Peter Lynch always talked about, if I can show you quickly, Peter Lynch always, this guy was amazing, and basically he has a book called One Up on Wall Street. I will share the link below. So if you want to ever buy that book, it's brilliant. Honestly, by far one of the best books that I've read. Especially, it kind of gives you perspective of what the market is like, what to buy, what not to buy, and the hype. So how to avoid all of that rubbish. But he basically talked about something called 10 baggers, and what he said was basically 10 bags are an investment that returns 10 times its initial purchase price. Okay, 10 bags start out as stocks that have a strong earnings growth but still trade at a reasonable valuations. Okay, so this is important. This is really important, and the companies that we're looking at today, they are trading reasonable valuations according to Morningstar and other companies. So we're going to look at the cybersecurity sector right now, and then we'll see if there's some of these companies are actually companies that we could potentially add to our portfolio. Now, I will be honest with you, there's a little bit of risk. Okay, there's a bit of risk, and this is, let me not say little bit of risk, this is huge risk. Okay, because some of these companies are not profitable yet. So what you're basically doing is you're betting on the fact that these companies are going to double their money or triple their money in the next few years, and they're going to continue growing their business and all of that stuff. So in terms of the cybersecurity side of the market, it's expected to grow $346 billion by the end of 2027. And for that reason, the reason this is happening is because there's been so many different attacks on huge companies, even including Microsoft, have had some sort of cyber attacks in the last 12 months. So this is now a growing industry. It's the hot industry. It's one of the best out there. And we want to see if some of the companies in that sector is actually a good investment for us. Okay, and again, this is not obviously financial advice. You're going to have to do your research. And again, this is not the normal dividend stocks where you're going to get a return on your investment. It is a very much predictable business. This is very speculative, so you're going to have to be careful with that. So the first company that we are going to look at is CrowdStrike. CrowdStrike basically is in the cybersecurity sector. They have like endpoint securities, they got cloud securities, managed services. They've got so many different things. So threat intelligence, identity protection. I've done a whole video on this. If you want to find it in YouTube, then you should be able to find them. Now, the company is currently trading $173 per share. Recently, they were almost at 300. I think it was even above 300. So they've actually had a little bit of pullback. They provide cloud delivered solutions for endpoints and cloud workload protection in the United States and other countries. Now, this is a very good thing, right? Because it's not just based on the US. So it's based on the UK and the US and all of the big countries in the world. They don't have any earnings. That's why they don't have a PE right now. But for the next year to 3 years, the expected growth or the future growth is 45%. So the expectation is this business is going to grow 50, 40, almost 50%, 45%. So you're buying a business that is way undervalued at the moment, and I'll show you that in a second. Return on equity is basically the money that the company receives from investors, okay, and the money they take as a debt. What do they do with it? Do they actually take that money and turn it into a profit? So right now they've got 21% return on equity, which is really high. They have recurring revenue, which means that a lot of the businesses that they work with, and they do work a lot of huge companies, will have a recurring subscriptions. So for example, like Adobe, you buy it once and then every month you have to pay, or every year you have to pay subscription to own it, okay? Current ratio, this is important when you're buying a company that is as small as this, okay? This shows, so the current ratio, if above 1, means they have they have enough money to pay off their debt. Anything below 1 is a very risky. Okay, so you're looking for a current ratio of 1. Normally I look for 1.5. If it's more than 1.5, it's absolutely perfect. Then revenue growth, okay, so they've got recurring revenue growth of 67% year-on-year growth rate. That is very, very high. According to Morningstar, the stock doesn't have a moat at the moment, so they don't have a competitive advantage. Basically, that's what it means. And then in terms of whether it is overvalued or undervalued, currently, as you see here, is fair valued. Okay, their price target is 200, and according to Simply Wall Street, they're basically saying it's undervalued about 40%, and the target price is in $296, and currently trading 173. So I own very small share of this company. I don't know if I'm going to add to it maybe this month, okay, but I will definitely be adding to this, and I'm going to hold on to this company because I actually genuinely like their business model. Right, so the next company we're looking at is PanW, or Palo Alto Networks. Again, this is the same industry again, okay. This company provides security solutions worldwide. The company offers a firewall, appliances and software, okay, panorama, and security management solutions to control firewall appliances and software deployed on end customers and an instance in public or private cloud environment. So again, in a nutshell, this is again another cybersecurity, is one of the biggest out there. I'm not sure what the market cap this company is, but I think it's slightly bigger than CrowdStrike. Again, their earnings is absolutely nothing right now. Okay, they're still growing. When you look at their 1 to 3 years future growth, again, it's very similar, 42%. You've got return on equity, 54% of return on equity. They have recurring revenue. Right now, their debt is slightly higher than I would have liked, okay? And they have revenue growth of year-on-year of about 32%. According to Morningstar, they have a white mode, they are fairly valued, and basically their target price is $585 per share. Now, Simply Wall Street has a different opinion, okay? They're actually predicting double almost to what Morningstar is predicting, which is very crazy because they say it is basically undervalued about 50%. I don't know what they know about this business, but that is very, very speculative. I'm not sure if that is a reliable information, but nevertheless, it's a great business. Again, if you're looking to add to your portfolio a company that you can buy and hold and forget about, okay, because you know they're going to grow their business in the next 3 years, okay, 42% or more in the next couple of years, okay, then maybe it's a good stock to add to. Again, do your research, find out a bit more about the company, okay. Just look at their recent financial earnings reports. They've got so much information in there, and they can basically explain everything, where the company is heading, how much customers they've got, who their customers are. So you've got a lot of information in there, okay. So if you go to the investor section, you will find all that information in there for you to basically digest and obviously understand the business better. Right, the next stock we're going to look at is Fortinet. Again, it's trading $304 per share at the moment. Again, this company also is security devices and data across networks, okay, endpoints and cloud. So they're very much similar to the rest of these companies. Their PE, the only one I think out of the 5 that I'm going to share with you today that has basically a PE, and that's very high. Okay, but again, it's better than the ones that actually don't have anything at the moment. The future growth is not as great. Okay, it's only 15% in the next 1 to 3 years. Return on equity about 30%. They have recurring revenue. Their debt is not actually bad at all. And then revenue growth year on year, basically you're looking about 36. They have a wide moat, fairly valued at the moment, $285 target price. And then Simply Wall Street is saying 26% undervalued and $422 is their target. And right now it's about 300. So another great business that you can look into. Again, go and check out their earnings reports in case of globally diversified company. They have so many going on in terms of social, in terms of governance, in terms of environment, and what they're doing. You can get to know the people that actually own that business, and you've got the whole financial details and where the company is heading in the next 5 to 10 years. So at least you have an idea before you start investing. Talk about in terms of cyber attacks, what has happened in the US in the last few years, how much they've spent. So you've got a lot of information in there that's very reliable, okay, that you could actually digest before you start investing in a business like this. All right, so the next one is yes. This company is also very similar. It operates as a cloud security company worldwide. They don't have a PE at the moment. And when you look at their future growth is only about 12% or about 13%. Earning return on equity is 25%, which is good. They have similar again. They have recurring revenue. Their current ratio is very, very good. Okay, you've got return on equity of 62%. They don't, according to Morningstar, they don't have a competitive advantage, but they are fairly valued at the moment. 265 is the Morningstar target price. Currently, it's 250, so not much. Okay, but when you look at Simply Wall Street again, they're looking about $446 per share. So that's almost a doubling where you are. So that's 42%, 43% upside to this business. The final company that we're going to look at is CloudStrike. And there's a little bit of a Cloudflare. Cloudflare was a company that I actually purchased when they were $40 per share. I think I saw that it was when it hit about 80 or 90. This was a long time ago. That was early 2020. Again, they're very similar. So they operate a cloud platform that delivers a range of network services to businesses worldwide. Sometimes on your browser, you will see this company actually doing a networking some sort of security check in the background when you're actually accessing certain companies. And in terms of growth, again, very similar, 1 to 3 years, you're looking about 31%. The future return on equity, 3.6%. Very, very bad. I don't really like that. So basically what this means, the company, the management in the company are not actually doing amazing, basically good things with our money. Okay, that's the thing. But then again, when you look at their revenue growth, is actually great. And then you look at their current ratio, they don't have any debt, this company. So this is a good thing, but I don't like the return on equity side of things. Okay, but you're looking about 67% return on revenue growth year on year in the next couple of years. And that's amazing. When it comes to competitive advantage, they don't have any at the moment, according to Morningstar, and they are discounted 27%. So this is according to Morningstar, this company is actually undervalued. It should be about $136 per share, but right now it's $93 per share. And then when you look at the undervalued, and they are undervalued when you look at Simply Wall Street, that's about 18% down, $122 per share. Right, so every single company that we looked at today is actually very speculative companies. They've been around not a long time, okay? And you really have to be careful. And what I mean by that is just these companies can change. Their business is great. They are fine. There's nothing wrong with them. Because of high interest rates and so on, they might not be able to borrow. Because remember, these companies are still investing in the future. So they need to borrow some money from the banks. And if that is the case, they have to pay high interest. So they might struggle to raise money and they might struggle to grow in the next few years. So it's risky. But obviously, one of the things Peter Lynch always talks about is in terms of the 10 baggers or the fast growers, he always says that obviously there's little elements of risk in every investment. But when it comes to companies like this, there is a massive risk that you're taking. but the reward is great. So it's the kind of risk reward kind of thing. And if you're into these tech companies that are growing fast and so on, then maybe the cybersecurity side of things, it might be interesting to look at, because if basically the market is going to grow in the few years, in the next few years, and so far what we've seen in terms of attacks and companies that was holding ransom and so on, these companies are the companies that actually normally help them. They have the right platforms, they work with some of the biggest industries. So CrowdStrike, for example, they are the sponsor, one of the sponsors for Mercedes and Lewis Hamilton's car. If you look at it, it actually says CrowdStrike, and he actually does advertisements for them. So they are growing this business, they have a good model. As you can see, the revenues are amazing, that's perfect. And the fact they have these recurring revenues, that is great. And at the moment, a lot of them are undervalued. So sometimes when, right now is everybody's switching from this type of companies into value companies, like companies that have a dividend, companies that can sustain their growth, whatever, like 2-3% growth, 5% growth, 10% growth. That's basically what is attractive at the moment, and that's what people have been switching to lately. But there might be, if you do your research and you fully understand how the business is going to go in the next few years, and you're patient enough, you could potentially make some money in this type of business. Again, you might lose a lot of money, but at the same time you could make money. So it's a risk reward thing. You have to think about it. What's your risk appetite? Have you got a couple of £1,000 that you're willing to lose and put into CrowdStrike and forget about it? If that's the case, maybe look into it. Again, whatever you do, just look at their research, look at the research, look at each one of these companies and what they do. Once you understand their business model literally inside out, then maybe look at it into investing in this business. I hope you enjoyed that video. Again, I'm going to do a few more videos on this type of videos, because I realized obviously I don't have that many growth stocks, but at the moment, the way the stock market is going, you might actually lose out. There might be values in these companies, and the fact that a lot of them are undervalued at the moment, that tells us maybe it is time maybe to put a little bit of money into this. Not a lot, but a little bit of your money. Anyway, I hope you enjoyed. Take care. Assalamu Alaikum.